While inflation hit 9.1% in June of 2022, and food prices have continued to skyrocket, most investors watch their portfolios plummet. But here's what mainstream financial media isn't telling you. Economic disruption has historically created more wealth for average investors than bull markets. In fact, a study of the last 3 major recessions shows that ordinary people who followed specific countercyclical investment patterns saw average returns of 270% in the 5 years following each crash. Today, I'll break down exactly how they did it, with real examples, real numbers, and the exact same opportunities appearing in today's market. The millionaire pattern. How economic crashes create more wealth than bull markets. Did you know that more millionaires emerged from the Great Depression than any other time in American history? It sounds counterintuitive, right? While most people watch their retirement accounts shrink during economic downturns and focus solely on avoiding losses, history tells a different story. One where recessions actually create some of the greatest wealth-building opportunities. This completely contradicts everything mainstream financial media bombards us with during uncertain times. Turn on any financial news channel during a market downturn, and what do you hear? Protect your assets. Move to cash. Weather the storm. It's always about defense, never offense. But what if playing defense is actually the wrong move when everyone else is panicking? Enter the concept of countercyclical investing, the strategy of buying assets when everyone else is selling them out of fear. It's the financial equivalent of running into a burning building while everyone else is running out. Sounds crazy until you look at the data. Investors who had the courage to buy during the bottom of the 2008 financial crisis saw average returns of 270% over the following 5 years. Let that sink in, more than tripling your money in half a decade. Those who bought S&P 500 index funds in March 2009 didn't need complex trading strategies or insider knowledge. They simply needed the courage to act when blood was in the streets. What makes market crashes such powerful wealth creation engines? They create massive discounts on quality assets, essentially putting stocks, real estate, and businesses on sale at prices that would be unthinkable during normal economic times. During the 2008 crash, blue-chip companies with strong balance sheets and decades of consistent performance were trading at 50 to 70% discounts simply because everyone was selling everything. Think about it like this. If your favorite store suddenly offered everything at 50% off, would you run away in fear or grab your wallet and stock up? Most people instinctively recognize value in consumer goods, but completely miss it in financial assets. The real barrier isn't knowledge, it's emotion. Our brains are hardwired with powerful psychological biases that make it extremely difficult to buy when everyone around us is panicking. The amygdala, our brain's fear center, essentially hijacks our decision-making process during periods of extreme market stress. This emotional decision-making prevents most people from recognizing these rare opportunities when they appear. While the majority sell at the worst possible time, a small percentage of investors have learned to overcome these psychological barriers. They've trained themselves to recognize the patterns that repeat across different economic cycles and market crashes, and the results can be life-changing. In this video, I'll show you 3 case studies of completely ordinary people who spotted these patterns and acted while everyone else froze. None of them had special connections, insider information, or even financial backgrounds. They were a teacher, a college student, and a retail worker who simply applied a specific set of principles during economic uncertainty. What's particularly fascinating is how these wealth creation opportunities don't just appear in stock markets. Throughout history, economic disruption has consistently created more millionaires than stable periods across multiple asset classes, from real estate and businesses to commodities and securities. The reason is simple. Economic volatility accelerates the transfer of assets from emotional decision-makers to disciplined ones. The 2020 pandemic crash demonstrated this pattern perfectly. Those who recognized the disconnection between market panic and economic reality positioned themselves for returns exceeding 100% in many sectors within just 12 to 18 months. And right now, similar patterns are beginning to emerge in today's market. Case study number 1. The teacher who turned $80,000 into $1.2 million during the 2008 crash. Patterns don't just make people rich, actions do. When the 2008 financial crisis hit, and the average investor lost 40% of their portfolio, Sarah was teaching algebra by day and making millionaire moves by night. How did a teacher on a $58,000 salary manage to transform $80,000 into $1.2 million during the exact moment when financial experts were predicting the end of the banking system as we knew it? Meet Sarah, a 42-year-old high school math teacher from Ohio. She wasn't a Wall Street insider or finance major, just someone who paid attention to patterns. In 2007, Sarah had been carefully building her retirement savings for years, accumulating about $80,000 while never earning more than $58,000 annually. When housing prices started showing cracks and financial news turned increasingly negative, Sarah didn't panic like most investors. "I noticed everyone running for the exits," Sarah recalled. "But as a math teacher, I thought about probabilities differently. The worse things got, the more I saw opportunity forming." While her teacher colleagues frantically pulled their money from the market to prevent further losses, Sarah took the complete opposite approach. She created what she called her Opportunity Fund, a mental account separate from her core retirement savings specifically designated for crisis investing. What made Sarah's approach unique was her laser focus on the financial sector itself, the very epicenter of the crisis. As financial stocks and ETFs like the Financial Select Sector SPDR Fund, XLF, plummeted 60 to 70% in value, Sarah systematically purchased shares every 2 weeks with her teacher's salary. "Everyone thought I was crazy for buying bank stocks when they were failing," she explained. "But I wasn't buying the failing banks. I was looking for financial institutions with strong balance sheets that were being unfairly punished alongside the actual problem companies." Sarah's research process wasn't complicated but required discipline. She specifically targeted banks like JP Morgan Chase, Wells Fargo, and Goldman Sachs that demonstrated resilience despite market panic. She studied their capital positions, evaluated their risk management practices, and determined which institutions had the financial strength to weather the storm. The true genius in Sarah's approach wasn't just what she bought, but how she bought it. Using a strategy called dollar cost averaging, she continued buying shares at regular intervals regardless of price fluctuations. This disciplined approach meant she accumulated substantially more shares as prices fell further throughout 2008 and early 2009. "The math made perfect sense," Sarah said. "If I believed these companies would eventually recover, then buying more shares at $10 than I could at $30 was simple multiplication. The lower prices went, the more excited I got about my future returns." Another brilliant component of Sarah's strategy was her focus on dividend-paying stocks. Even as share prices dropped, these companies continued distributing quarterly payments, which Sarah automatically reinvested to purchase additional shares at even lower prices. "Getting those dividend checks during the crash was psychologically powerful," she noted. "While everyone else saw only losses, I was receiving actual income from my investments. It completely changed my perspective on the crisis." The psychological aspect of Sarah's approach can't be overstated. By creating a separate mental account for her Opportunity Fund, she freed herself from the emotional turmoil affecting most investors. When colleagues expressed horror at their shrinking 401k statements, Sarah viewed her investments differently. Not as losses, but as discounted purchases of assets she planned to hold for years. By 2015, Sarah's initial $80,000 investment had grown to an astounding $1.2 million. The financial sector stocks and ETFs she purchased during the depths of the crisis rebounded dramatically as the economy recovered. Her strategic purchases of shares at 60 to 70% discounts multiplied in value several times over. Case study number 2. The college student who spotted overlooked value in the dot-com crash. While Sarah was turning financial disaster into fortune, on the opposite coast, a broke college sophomore was about to prove that market crashes don't discriminate by age or bank account size. Meet Jason, a 19-year-old computer science student at UCLA with just $2,500 in savings from his summer job. As the Nasdaq hemorrhaged a staggering 78% of its value between 2000 and 2002, Jason wasn't panicking. He was strategically planning his entry. "Everyone was running away from tech like it was radioactive," Jason later recalled. "But I kept thinking, the internet isn't disappearing. It's just getting started." What made Jason's approach different was his natural skepticism toward the flashy dot-com darlings that dominated headlines. Instead of chasing companies with skyrocketing valuations and zero profits, he focused on what he called the boring backbone, the infrastructure companies that actually made the internet function. While his classmates were day trading trendy stocks, Jason methodically researched companies with three key criteria: positive cash flow, low debt levels, and services so essential they couldn't be eliminated even in a severe downturn. He wasn't interested in companies promising to revolutionize pet food delivery. He wanted the businesses building the actual technological highways. What he discovered shocked him. Companies like Amazon had fallen approximately 95% from their highs, plummeting from $113 to a mere $6 per share. Cisco Systems, the internet networking giant, had crashed from $82 to just $8. These weren't fly-by-night operations. They were foundational tech companies with real revenue that had been unfairly dragged down in the mass hysteria. These weren't just random gambles, Jason explained. Oracle and IBM were still generating consistent cash flow and had solid balance sheets, but they were being priced like they were going bankrupt tomorrow. What truly set Jason apart was his disciplined accumulation strategy. Working 20 hours weekly at the campus computer lab for $8.75 an hour, he automatically invested $220 every month, regardless of market conditions. When his friends questioned his sanity for buying dying tech stocks, Jason stuck to his thesis. The companies building and maintaining critical internet infrastructure will always be necessary, even if the flashy dot-coms disappear. His approach was refreshingly low-tech. Jason kept a simple spreadsheet tracking companies with positive earnings that had fallen more than 75% from their highs. When major analysts downgraded these stocks, driving prices even lower, he would buy more. He wasn't trying to time the exact bottom. He was gradually accumulating quality at fire sale prices. The internet itself isn't going away, became his mantra. People are conflating bad business models with bad technology. The infrastructure powering digital transformation is only becoming more valuable. His most contrarian move came when he started buying Amazon after it had fallen over 90%. While financial media painted Amazon as just another failed .com, Jason saw something different. A company building the most efficient retail logistics platform in history, with customer data advantages competitors couldn't match. By 2007, the tech sector had staged a remarkable recovery. Cisco rebounded from its $8 low to approximately $30 per share. Oracle, which had crashed to around $10 in 2002, recovered to over $20. But Amazon proved to be his most prescient investment, climbing from $6 to over $90, delivering returns exceeding 1,400%. Jason's initial $2,500, combined with his consistent monthly contributions from his part-time job, had grown to over $350,000 by 2007. All this from a college student who never had more than a few $100s at any time to invest, but understood the powerful combination of value recognition and systematic buying. The key to Jason's success wasn't complicated market timing or sophisticated trading strategies. It was his ability to separate temporary sentiment from fundamental value, focusing on companies with strong cash positions that could weather the storm while continuing to innovate. Case study number 3. The retail worker who built a $3.5 million portfolio during the pandemic. Fast forward to 2020. While Jason's tech investments were paying off handsomely from the dot-com crash, across the country, a retail manager named Maria was spotting another massive opportunity that most investors completely missed. When COVID sent markets plunging 35% in March 2020, many panicked and sold everything. But Maria, a 38-year-old department store manager with no finance degree, saw something different, a familiar pattern she'd studied for years. "I'd been preparing for a major market crash since 2018, Maria explained. "I kept about 30% of my portfolio in cash specifically for what investors call a black swan event, something unexpected that rocks the entire market." What made Maria's approach different wasn't just having cash ready. It was her laser focus on the sectors hit hardest by the pandemic. While most investors avoided travel, hospitality, and entertainment companies like the plague, literally, Maria did the opposite. "When I saw Marriott's stock drop over 60% in just weeks, I knew this was the opportunity I'd been waiting for," she said. "Hotels don't just disappear, they have real physical assets. and Marriott had $4.4 billion in cash reserves. They weren't going anywhere. Maria's strategy targeted companies in three specific sectors: hospitality, travel, and entertainment, that took the heaviest beating during lockdowns. But she wasn't just blindly buying anything with a big discount. Her research process was methodical. First, she identified companies with substantial cash reserves that could survive at least 18 months of severe disruption. Major hotel chains like Marriott and Hilton had the liquidity to weather the storm, unlike smaller chains drowning in debt. Second, she looked for businesses with irreplaceable physical assets. Airlines owned actual planes. Hotel chains owned prime real estate. These weren't just digital businesses that could evaporate overnight. What's fascinating is how Maria leveraged the market's extreme volatility. Rather than just buying shares outright, she implemented options strategies to generate income while waiting for recovery. The options market went crazy during the pandemic, Maria explained. I could sell covered calls against my positions and earn premium income while waiting for the stocks to recover. This strategy was particularly effective as options trading volume increased by 50% in 2020 compared to the previous year. Perhaps Maria's most valuable tool wasn't financial but psychological. She maintained what she called a crash journal, documenting market sentiment each day to avoid getting swept up in the constant doom-scrolling news cycle. One day I wrote, CNBC says travel industry dead forever. Carnival Cruise Lines down another 15%. Everyone says cruise industry will never recover. That was exactly when I bought more, she laughed. When everyone says never, that's usually the bottom. Her journal entries helped her stay focused on fundamentals rather than headlines. When Delta Airlines reported losses of $12.4 billion in 2020, most investors fled. Maria checked their balance sheet instead and found they had enough liquidity to survive until travel resumed. The results speak for themselves. Her position in Carnival Cruise Line, purchased at around $8 in March 2020, soared to over $27 by June 2021, a 237% return. Disney, another core holding, jumped from $79 to $187 in just 1 year as the company pivoted to streaming while theme parks were closed. By leveraging options, focusing on cash-rich businesses with physical assets, and maintaining emotional discipline, Maria transformed her $800,000 portfolio into $3.5 million between 2020 and 2023. All this while working her regular retail management job through one of history's most uncertain economic periods. The pandemic crash wasn't different from previous market panics. It was just faster, Maria noted. Same emotional overreaction, same discounting of obvious future recovery, just compressed into weeks instead of months. The 5 common patterns across all successful recession investors. What if the most powerful investment tool isn't a sophisticated trading algorithm or insider knowledge, but something you already possess? Maria's observation about the emotional patterns in market crashes points to something far more fundamental than stock-picking skills. When we analyze the stories of Sarah, Jason, and Maria, something remarkable emerges. Despite investing in completely different decades, different asset classes, and during different types of economic crises, they all followed virtually identical psychological playbooks. The secret to their success wasn't some complex investment strategy. It was their mental approach. Let's break down these 5 psychological patterns that separated our recession millionaires from the panicking crowds. Pattern number 1, emotional preparation before market crashes even occurred. All 3 investors had mentally rehearsed how they would respond to a market downturn long before it happened. This preparation completely eliminated the shock factor that paralyzes most investors. They understood the risks involved with their investments and had clear strategies ready to deploy when markets turned south. This advanced preparation meant they could act decisively while others were still processing what was happening. Pattern number 2, they all created dedicated opportunity funds specifically for market crashes. This wasn't just about having cash on hand. It was about psychological compartmentalization. By designating specific money for downturns, they removed the mental barrier of risking their main portfolio. Sarah's separate account for financial stocks, Jason's monthly contribution system, and Maria's 30% cash reserve all served the same psychological purpose, creating mental permission to buy when everyone else was selling. Pattern number 3, They maintained laser focus on cash flow and fundamentals while ignoring price movements and headlines. During market crashes, they completely tuned out the noise of daily price swings and sensationalist news coverage. Instead, they analyzed balance sheets, cash reserves, and long-term business viability. This focus on underlying business health, rather than stock price, allowed them to spot quality investments that were temporarily undervalued due to market-wide panic. Pattern number 4. Each investor implemented systematic buying plans that removed emotional decision-making during volatility. Rather than trying to perfectly time the bottom, which is impossible, they created mechanical buying systems. Sarah's biweekly purchasing schedule, Jason's monthly contributions, and Maria's staged entry points all accomplished the same goal, eliminating the paralyzing question of is now the right time to buy, by making the buying process automatic. Pattern number 5. They all shared an unshakable conviction that market recovery was inevitable, even if the timing was unpredictable. This wasn't blind optimism. It was based on studying market history. They recognized that every market crash in history had eventually recovered, and their investments were positioned to capitalize on this inevitable upswing. This freed them from the anxiety of trying to predict exactly when the recovery would happen. The most fascinating aspect of these 5 patterns? They're all psychological frameworks rather than technical investment strategies. The true difference between our recession millionaires and those who lost money wasn't superior market knowledge. It was superior emotional control. This explains why many professional investors with advanced degrees and sophisticated models still make catastrophic mistakes during market crashes. They've mastered the technical aspects of investing, but failed to implement these crucial psychological frameworks. Meanwhile, a high school teacher, a college student, and a retail manager, none with formal financial training, the repeating investment patterns across all major economic downturns. While mindset separates winners from losers during market crashes, the market itself reveals predictable patterns that few investors recognize. Think about it. What if the roadmap to recession riches has been right there all along, repeating itself across every major economic downturn from the Great Depression to the 2008 financial crisis? These 6 recurring market behaviors create a playbook that's surprisingly consistent, even when the causes of each recession couldn't be more different. When markets panic, the first pattern emerges immediately. Quality companies get hammered alongside terrible ones. This indiscriminate selling creates perhaps the biggest opportunity for smart investors. During every major downturn, from the 1970s oil crisis to the 2020 pandemic, solid businesses with strong fundamentals temporarily trade at the same discounts as companies truly on the brink of disaster. This market inefficiency is like a department store accidentally marking down premium merchandise alongside clearance items. The second pattern involves dividend stocks, which consistently show remarkable resilience while still offering substantial buying opportunities. These cash-flowing investments typically experience less dramatic drops during market panics, yet still trade at significant discounts to their intrinsic value. Think of dividend aristocrats, companies that have increased dividends for 25-plus consecutive years, as businesses that continue paying you while you wait for market rationality to return. Pattern number 3 is particularly fascinating. Sectors directly hit by the crisis almost always fall hardest, but recover with the most explosive growth. Look at banking stocks after 2008, tech infrastructure after the dot-com bubble, or travel companies following the pandemic. The very industries at the epicenter of each crisis often deliver the most stunning comebacks once the dust settles. Why? Because panic-driven selling pushes prices far below reasonable valuations, creating massive upside potential once fear subsides. Small-cap companies with fortress-like balance sheets represent our 4th pattern. These nimble businesses consistently outperform during recovery phases. Unlike their larger counterparts, these smaller companies can quickly adapt to changing economic conditions, pivot their business models, and capitalize on opportunities that larger corporations miss. Their smaller size means they can double or triple revenue much faster than established giants during economic rebounds. The 5th pattern might be the most counterintuitive yet reliable signal: investor sentiment hitting maximum pessimism just before market bottoms. When financial headlines reach peak negativity, magazine covers predict economic doom, and your neighbor suddenly becomes an expert on why this time is different. That's precisely when markets typically find their floor. This sentiment extreme acts as a powerful contrarian indicator that has marked the turning point in virtually every recession. The final pattern completes our recession playbook. Market recoveries always begin while economic news remains overwhelmingly negative. This timing mismatch confuses most investors, who logically wait for green shoots in economic data before re-entering markets. By then, they've missed the initial 20 to 30% of the recovery. Markets don't wait for unemployment to improve or GDP to rebound. They move 6 to 9 months ahead of economic indicators, anticipating recovery long before it appears in headlines. These 6 patterns don't just apply to a single recession or market cycle. They've repeated across every major economic downturn for the past century. The Great Depression, stagflation in the 1970s, Black Monday in 1987, the dot-com crash, the 2008 financial crisis, and the pandemic panic of 2020 all followed this same playbook. The causes were vastly different, but market behavior remained surprisingly consistent. The 5 warning signs that signal it's time to position your portfolio. Understanding market patterns is powerful, but recognizing the precise moment to act is where ordinary investors become extraordinary wealth builders. When the market is crashing and headlines scream doom, 5 distinct signals have historically marked the perfect buying window. The same signals that allowed average people to build fortunes while their neighbors panicked. Let's be clear, I'm not talking about timing the exact market bottom. That's a fool's errand even for Wall Street's elite. What I'm talking about is identifying the opportunity zone. That sweet spot where fear has created massive disconnects between what companies are worth and what they're selling for. The first warning sign to watch for is when the VIX index, often called the fear gauge of Wall Street, surpasses 40. This mathematical measure of market anxiety typically hovers between 15 to 20 during normal times. When it spikes above 40, it signals extreme investor fear and uncertainty. During the 2020 pandemic crash, the VIX skyrocketed past 80, creating one of the most significant buying opportunities in decades for investors who recognized this signal. The second indicator appears when quality companies trade at 40 to 60% below their 52-week highs despite maintaining stable business fundamentals. This isn't about catching falling knives. Companies with deteriorating businesses deserve their discounts. I'm talking about rock-solid operations getting punished simply because they exist in a scary market. These temporary disconnects between price and value have created some of the most significant wealth-building windows in market history. The third signal flashes when dividend yields on blue-chip stocks exceed 10-year Treasury yields by 2 percentage points or more. This yield gap creates a fascinating opportunity. You're essentially getting paid substantially more to own pieces of excellent businesses than you are to loan money to the U.S. government. When this spread widens dramatically during market downturns, it has consistently signaled undervaluation in quality dividend-paying stocks. The fourth indicator to monitor is when price-to-earnings ratios contract significantly below their 10-year averages. This valuation compression often happens across entire sectors during market panics, creating broad-based buying opportunities. The market essentially puts quality companies on clearance sale, allowing you to purchase future earnings streams at steep discounts to their historical prices. The fifth and perhaps most telling signal is when insider buying activity spikes dramatically. When executives and board members start purchasing substantial amounts of their own company stock with personal funds, it's worth paying attention. These insiders have the deepest understanding of their businesses and typically only make significant personal investments when they believe shares are severely undervalued relative to future prospects. What makes these 5 signals so powerful is their convergence. When multiple indicators flash simultaneously, they create a high-probability entry zone. During the 2008 financial crisis, all 5 signals appeared within months of each other, creating the buying opportunity that Sarah, our teacher case study, used to transform her modest savings into over $1 million. The same pattern emerged during the dot-com crash, allowing college student Jason to spot tremendous value in oversold tech infrastructure companies. Even more remarkable, during the pandemic crash of 2020, these signals compressed into just weeks rather than months. The VIX spiked to historic levels. Quality travel and hospitality companies traded at 60% discounts despite having cash reserves to weather the storm. Dividend yields skyrocketed relative to treasuries, PE ratios compressed dramatically, and insider buying reached levels not seen since 2008. Maria, our retail manager case study, recognized these convergent signals and positioned her portfolio accordingly, leading to that remarkable $3.5 million outcome we discussed earlier. Today's market, the same patterns emerging again. What Maria's story teaches us goes far beyond a single success. The same wealth-building patterns that created millionaires in previous downturns are starting to appear right now in today's market. While headlines obsess over inflation fears and interest rate concerns, they're completely missing the opportunity zones forming under our noses. The S&P 500 has climbed over 27% year-to-date, hovering just above 6,000 points at the start of December 2024. This might seem like everything's already recovered, but dig deeper and you'll find the same disconnects that savvy investors exploited in previous crashes. Market analysts are projecting the index to reach between 6,500 and 7,000 in 2025, suggesting significant growth potential despite current economic uncertainties. What's truly exciting is seeing those classic opportunity signals emerging again. Let's look at what's happening right under everyone's radar. Fixed income markets are presenting attractive opportunities that most retail investors are completely overlooking. As Dan Ivison from PIMCO recently noted, there's exceptional value in fixed income today due to unusually attractive yields. These higher yields are creating the exact same entry points that recession millionaires pounced on in earlier downturns. The insider buying activity tells an even more compelling story. Company executives across multiple sectors are purchasing their own stock at increased rates, a powerful indicator they believe their companies are undervalued. This mirrors exactly what happened before massive rebounds in previous recessions. When those running the companies put their own money on the line, it's worth paying attention. Current market sentiment indicators are approaching levels historically associated with buying opportunities. While not yet at extreme fear levels, they're moving in a direction that historically precedes significant upswings. The wealth effect is also working in our favor, with household wealth reaching nearly $146 trillion. This unprecedented level of consumer wealth typically drives spending, which further accelerates economic growth and creates a positive cycle for investors positioned correctly. Perhaps most telling is that dividend yields from quality companies are now exceeding treasury yields by significant margins. This pattern has consistently preceded major market recoveries throughout history. When solid businesses are paying you more to own their stock than the government pays for its bonds, it's often a signal that stocks are undervalued. The opportunity isn't evenly distributed across all sectors, though. Just like in 2008 when financial stocks were unfairly punished, or in 2020 when travel and hospitality stocks were decimated, today's market has specific sectors trading at significant discounts despite having solid fundamentals. These disconnects between price and value are creating the perfect storm for investors who recognize the pattern. What's especially interesting about today's environment is that economic uncertainty is expected to persist, with periods of high bond yields and market volatility. This ongoing uncertainty actually creates the perfect conditions for strategic investments. History shows that the greatest wealth-building opportunities emerge not when everything feels safe, but during these periods of uncertainty when emotional investors flee and assets get mispriced. The pattern is clear. Economic disruption creates wealth transfer opportunities. The money doesn't disappear during downturns. It simply moves from emotional investors to disciplined ones. The current market environment is setting up this transfer once again. Starting small. How to position your portfolio with just $100. This wealth transfer isn't just for those with deep pockets. Remember when I mentioned how money moves during market turbulence? The exciting truth is that you can position yourself on the receiving end of this wealth transfer with as little as $100. Let me show you how our case study investors would approach today's market if they were starting with minimal capital. Most financial experts act like you need thousands to start investing, especially during economic uncertainty. They'll tell you to wait until you have more capital or focus on saving first. But our case studies reveal something completely different. It's not your starting amount that matters most, it's your approach and consistency. What if I told you that platforms like Robinhood, M1 Finance, and Stash now offer something that would have changed the game for our investors? It's called fractional share investing, and it lets you buy portions of expensive stocks rather than whole shares. Imagine being able to own a slice of a $500 stock with just $5. These platforms have zero minimum requirements, meaning you can start with literally $1 if that's what you have. But here's the real magic. ETFs, exchange-traded funds, are your best friend when starting small. With minimums as low as $50 or sometimes none at all, you can instantly gain exposure to entire sectors that our case study investors identified as undervalued. Instead of trying to pick individual winners, you're buying baskets of companies positioned to benefit from economic recovery. If Sarah, Jason, and Maria were starting with $100 today, they'd all implement the same fundamental strategy, creating a systematic buying plan. They'd commit to adding even small amounts every week or month, regardless of market conditions. This approach removes the pressure of timing the market perfectly and harnesses the power of consistency. But they wouldn't just buy anything. They'd prioritize investments based on value disconnects, focusing first on the sectors showing the most significant gap between current price and intrinsic value. This selective approach means even with limited capital, you're targeting the opportunities with the highest potential returns. One of the most powerful wealth-building tools, especially when starting from market lows, is dividend reinvestment. When you automatically reinvest your dividends to buy more shares, you're creating a snowball effect. The beauty of dividend reinvestment plans, DRIPs, is that they often come without additional fees, meaning every penny works for you. And during market downturns, those dividends buy more shares at lower prices, automatically implementing the buy low part of successful investing. Warren Buffett's journey illustrates this principle perfectly. He didn't start with millions. He began investing with modest amounts in his youth. His secret wasn't having huge capital. It was understanding the power of compounding and consistently investing during market downturns. Research shows that small, regular investments made during market bottoms can produce remarkable results over time. Imagine investing just $100 monthly during a downturn. As markets inevitably recover, those modest contributions can compound into significant wealth. The mathematics of starting from market lows work dramatically in your favor. The most critical lesson from our case studies isn't about the amount they started with. It's about their consistency and mindset. They understood that economic uncertainty doesn't require big money to capitalize on. It requires discipline and a contrarian perspective. The simple diversification strategy that protected our case study investors. Discipline and mindset are critical for successful investing, but there's another layer that sets recession millionaires apart. A strategic approach to diversification that balances protection with opportunity. What's remarkable about Sarah, Jason, and Maria isn't just their psychological resilience during market chaos. It's their identical approach to allocating capital. Despite investing in completely different recessions and markets, they all utilized what I call the 40-30-20-10 framework to position their portfolios. Let's break down this simple yet powerful strategy that protected them from devastating losses while still capturing enormous upside potential. The backbone of this framework is the 40% allocation to quality dividend stocks with strong balance sheets and healthy cash flow. These companies aren't just survivors, they're the ones poised to thrive during recovery phases. Quality dividend payers have historically outperformed during market rebounds, delivering both income and substantial capital appreciation. This core holding provides stability while still participating in market upswings. The next 30% of their portfolios went toward deeply discounted growth opportunities in sectors directly impacted by the crisis. This is where the real wealth creation happens. These investments target companies with strong fundamentals that were unfairly punished simply because of their association with affected industries. The massive gap between price and value in these sectors creates the potential for explosive returns once market sentiment shifts. A critical 20% allocation went to defensive assets that acted as portfolio stabilizers during continued volatility. This portion served as their safety net, cushioning against further market declines while they waited for recovery to take hold. Think of this as the shock absorber that allowed them to stay invested even when markets remained turbulent. The final 10%, what I call the moonshot allocation, targeted asymmetric risk-reward opportunities. These investments have limited downside, but potentially massive upside. Even if these higher-risk plays don't all pan out, the ones that do can deliver outsized returns that meaningfully impact overall portfolio performance. What makes this framework so effective is the balance it strikes between protection and opportunity. Unlike conventional wisdom that pushes investors toward either extreme, all cash or all in, this approach provides downside protection while maintaining significant upside exposure. The results speak for themselves. This diversification strategy shielded our case study investors from approximately 70% of market losses during the worst phases of their respective crashes. But more importantly, it positioned them to capture the full upside when markets recovered. Dollar cost averaging amplified these results even further. By systematically deploying capital at regular intervals rather than attempting to time exact bottoms, our investors continually lowered their average cost basis as markets declined. This approach works particularly well during extended downturns, allowing investors to accumulate more shares at bargain prices. The beauty of this framework lies in its simplicity and adaptability. You don't need complex hedging strategies or sophisticated trading systems to implement it effectively. The percentages provide clear guidance while allowing flexibility to adjust based on your personal risk tolerance and time horizon. Consider how you might apply this approach today. The 40% quality dividend allocation could include companies with decades of consecutive dividend increases that have demonstrated resilience through previous downturns. The 30% discounted growth portion would target fundamentally sound businesses in sectors currently facing headwinds. Your 20% defensive allocation might include assets that historically perform well during volatility, while the 10% moonshot bucket could contain select opportunities with significant potential upside. This isn't just theoretical. It's the actual blueprint used by ordinary people who transformed market chaos into personal wealth. By adopting this same framework, you position yourself to not just survive economic uncertainty, but potentially thrive through it. The undervalued. Sector showing all classic pre-growth indicators. While our framework provides the overall structure for recession investing, today there's one sector exhibiting all 5 classic pre-growth indicators that appeared before massive recoveries in 2008, 2002, and 2020. The gap between current prices and actual value in this sector resembles a coiled spring, compressed now, but potentially explosive when market sentiment finally catches up to reality. That sector is finance. Right now, financial companies are trading at multi-year lows despite maintaining fundamentally strong positions. It's the same pattern we saw before explosive growth periods in previous market cycles, but most investors are missing these signals because they're fixated on inflation headlines and interest rate anxieties. So why are financials being punished so severely? The market has lumped quality financial institutions together with weaker ones, creating a sector-wide sell-off that ignores the vastly different risk profiles between companies. This knee-jerk reaction creates the exact kind of buying opportunity that Sarah capitalized on during the 2008 crisis. When we examine the current fundamentals, many financial companies are sitting on record cash reserves, maintaining healthy profit margins and demonstrating resilience in their core operations. Yet their stock prices don't reflect this stability at all. This disconnect between price and value is the first classic indicator we're seeing. The supply-demand dynamics in the financial sector are particularly interesting right now. As retail investors flee, creating downward pressure on prices, we're seeing the beginning of a coiled spring effect. This compression can't last forever. When sentiment eventually shifts, there simply aren't enough shares available at these prices to satisfy renewed demand, potentially creating explosive upward momentum. Perhaps the most telling signal is the insider buying activity. Financial sector executives are purchasing their own company shares at unprecedented rates. These insiders have access to the most detailed information about their company's health and future prospects, and they're putting their personal money on the line, a powerful vote of confidence that the market is missing. For example, multiple board members and C-suite executives at major financial institutions have increased their personal holdings significantly over the past quarter. They're not just talking about value, they're backing it up with their own cash. This mirrors exactly what we saw during the early stages of recovery in our previous case studies. Looking at the historical parallels, the financial sector's current setup is remarkably similar to tech infrastructure companies in 2002. Back then, as Jason discovered, quality tech infrastructure companies were unfairly punished alongside unprofitable dot-coms. Today, we're seeing strong financial institutions dragged down by broader market fears despite their solid operational performance. The valuation metrics tell the same story. Price-to-earnings ratios for many financial companies have contracted to levels significantly below their 10-year averages, while dividend yields from these same companies now substantially exceed Treasury yields. These are textbook signs of undervaluation that have preceded major recoveries in previous cycles. What makes this opportunity so compelling is that all 5 classic pre-growth signals are converging simultaneously in the financial sector. 1. Quality companies trading at deep discounts to their intrinsic value. 2. Strong fundamentals being overlooked due to sentiment rather than facts. 3. Supply-demand dynamics creating a compressed spring effect. 4. Insider buying activity spiking dramatically. 5. Valuation metrics showing extreme disconnect from historical norms. This pattern of signals has historically preceded returns exceeding 200% in the recovery phase. The financial sector today isn't just cheap. It's displaying the emotional mastery, how successful investors manage fear during market crashes. The financial sector may be primed for explosive growth, but here's the million-dollar question. Even if you spot the perfect opportunity, can you actually pull the trigger when your news feed is screaming financial apocalypse? While identifying undervalued opportunities is important, the real secret to recession investing isn't just what you buy. It's conquering the battlefield happening between your ears. Our case study investors weren't emotionless robots. They felt the same fear everyone does during market crashes. The difference? They implemented specific psychological techniques that transformed that paralyzing fear into profitable action. Think of it as emotional circuit breakers that prevent your fear response from overriding your rational investment strategy. Let's start with what I call the reverse news diet. When markets crash, most investors obsessively consume financial news, which only amplifies their anxiety. Our successful investors did the exact opposite. They systematically reduced their consumption of financial media during panics. This doesn't mean becoming uninformed, but rather being selective about information sources and limiting exposure to panicked headlines that trigger emotional reactions. Instead of watching CNBC for hours or refreshing market updates every 5 minutes, they scheduled brief, focused information sessions, often just 15 to 30 minutes daily, to review key metrics rather than opinions. This controlled exposure prevented the emotional contagion that happens when you're bombarded with catastrophic predictions all day. The second technique is the pre-commitment strategy. This approach involves making key investment decisions before emotional triggers occur. Our case study investors created detailed action plans during calm market periods that specified exactly what they would buy and at what price points if markets declined by certain percentages. For example, one investor had written instructions. If bank XYZ drops below $40, I'll invest 10% of my opportunity fund. If it drops below $30, I'll invest another 15%. By establishing these rules in advance, they removed emotional decision-making during the most stressful moments. The beauty of this approach is that it converts market drops from emergencies into opportunities to execute your pre-established plan. The third powerful technique is disaster rehearsal. Our investors mentally simulated worst-case scenarios long before they happened. This psychological inoculation dramatically reduced the emotional impact when actual market declines occurred. Rather than being blindsided by panic, they had already processed potential outcomes and developed response strategies. One investor would regularly ask herself, "What would I do if my portfolio dropped 40% tomorrow?" Then she'd mentally walk through her response plan, visualizing herself calmly executing her strategy rather than panicking. When markets actually plunged, she experienced what psychologists call emotional recognition. The feeling was familiar rather than overwhelming. Beyond these core techniques, our investors shared another powerful practice, documenting their thought processes during market bottoms. They maintained crash journals where they recorded market conditions, their emotional states, and investment decisions. These journals served multiple purposes. They created accountability, provided perspective during price swings, and became valuable learning tools for future downturns. One investor wrote in March 2020, "Market down 30%. Feeling strong urge to sell everything. Reminder, this is exactly when my strategy says to buy. Increase position in travel sector ETF as planned." This simple act of documentation created enough psychological distance to reconnect with his rational investment plan. Our investors also built accountability systems with trusted advisors who weren't emotionally caught in the same market panic. This might be a financial professional, investment club member, or even a financially savvy friend. The key was having someone who could provide objective feedback when emotions threatened to override their strategy. One study subject had a monthly call with her former economics professor throughout the 2008 crash. This external accountability prevented her from abandoning her buying strategy when newspaper headlines were predicting financial Armageddon. Interestingly, many of our case study investors incorporated mindfulness practices to reduce their emotional reactivity. Research shows these techniques help maintain calm and focus during stressful situations, creating the mental space needed for rational decision-making when markets are in freefall. The three-step framework for capitalizing on economic uncertainty. Mindfulness creates the mental clarity, but what turned that clarity into actual wealth? Every single one of our recession millionaires followed. Virtually the same three-step framework for capitalizing on market fear. A system so simple you'll wonder why Wall Street works so hard to make investing seem complicated. Let's break down how our case study investors transformed market chaos into serious money. Not through complex algorithms or insider information, but through a framework so straightforward you could implement it before this weekend. Step 1. Create your opportunity fund. Remember how Maria kept 30% of her portfolio in cash specifically for market downturns? That wasn't just good luck, it was strategic preparation. Every successful investor we studied maintained a dedicated pool of capital exclusively for buying during market volatility. This isn't about timing the market perfectly. It's about having financial ammunition ready when opportunities appear. Your opportunity fund should be separated both practically and psychologically from your regular savings and investments. This mental separation is crucial. It prevents you from feeling like you're losing money when markets temporarily drop further after you buy. How much should you set aside? Our research shows that even allocating 10 to 15% of your investment capital to this purpose can be effective. The key is having it ready and mentally labeled as crash capital before volatility hits. Step 2. Build your watch list. No successful recession investor makes random purchases during market drops. Each one maintains a carefully curated list of quality assets they want to own at specific price targets. Your watch list should include companies with strong balance sheets you'd be proud to own for 5+ years, assets currently trading above your target price that would become bargains during a downturn, specific entry price points based on valuation metrics, not emotions or round numbers. Jason's focus on tech infrastructure companies wasn't a random choice. He'd identified them as essential services with strong fundamentals that were being unfairly punished. Your watch list becomes your shopping list during market panic, eliminating the need to research investments when emotions are running high. Start by identifying 10 to 15 quality companies across different sectors. For each one, determine what price would represent exceptional value. This preparation pays dividends when markets tumble and everyone else is frozen with indecision. Step 3. Establish your buying rules. This is where most investors stumble. Without clear buying rules, emotional decision-making takes over during market volatility. Your buying rules should specify exactly what conditions will trigger a purchase, how much of your opportunity fund to deploy at each price level, what valuation metrics matter most for each type of investment. For example, if you've identified company X as a quality business currently trading at $100, your rules might dictate: buy 25% of my planned position if the price drops to $80, another 25% at $70, and the remaining 50% if it falls below $60. These aren't arbitrary numbers. They're based on valuation metrics like price-to-earnings ratios, price-to-book values, or dividend yields. The key benefit is removing in-the-moment decisions when markets are in free fall. The secret sauce that makes this framework effective is documentation. Each investor in our study maintained written records of their strategy, creating accountability during volatile periods. This documentation doesn't need to be complex. A simple spreadsheet or even a handwritten journal works perfectly. When emotional storms hit the market, having this framework documented serves as your anchor, preventing panic from hijacking your decision-making. It also allows you to evaluate your performance after the fact, creating a feedback loop for continuous improvement. The power of this approach lies in its simplicity. By separating your emotional response from your investment actions, you position yourself to act when others freeze. While the investment world is obsessed with complex strategies and timing the exact bottom, our case studies prove that a straightforward framework consistently delivers superior results. The 5 common mistakes that cause investors to miss recession opportunities. Having the right strategy is only half the battle. What about execution? Even armed with perfect knowledge, most investors still freeze when markets crash. The psychological hurdles are real, but there's something more insidious happening. Let's expose the 5 devastating mistakes that separate recession winners from those who watch opportunities slip through their fingers. The first mistake is waiting for the perfect bottom in the market. It's a trap that paralyzes even experienced investors. They watch prices fall and think, I'll jump in when it hits the absolute lowest point. But here's the reality. Nobody rings a bell at the market bottom. Our successful case studies never tried to time the exact low point. Instead, they recognized what experts call the opportunity zone, that period when quality assets are significantly undervalued regardless of whether prices might drop another 5 to 10%. This approach allowed them to accumulate positions gradually rather than missing the opportunity entirely. The second critical error is deploying capital too quickly. When markets first begin dropping, there's a temptation to rush in and spend your entire opportunity fund on the initial discount. This eagerness often leads to buyer's remorse when markets continue falling. Gradual capital deployment through techniques like dollar cost averaging proves far more effective during downturns. By spreading purchases over time, investors reduce the psychological burden of seeing positions temporarily lose value while maximizing buying power as markets decline further. Mistake number 3 focuses on price movements rather than fundamental business value. When markets turn volatile, many investors become fixated on daily price swings, constantly checking their portfolio value. This short-term thinking creates emotional decision-making. Successful recession investors instead concentrate on analyzing underlying business fundamentals, examining balance sheets, cash flow statements, and competitive advantages. They ask, is this business still operationally sound despite market fear? This focus on intrinsic value, rather than price fluctuations, grounds their decisions in rationality instead of emotion. The fourth mistake is overconcentration in a single sector. When investors spot opportunity in one beaten-down area, they sometimes go all in, believing they've found the ultimate bargain. This approach ignores the diversification principle that protected our case studies during market turbulence. Market recoveries rarely lift all sectors simultaneously. Some rebound quickly, while others lag for years. By maintaining positions across multiple sectors, recession millionaires captured gains from various areas as they recovered at different rates, creating a more stable growth trajectory for their overall portfolio. Finally, the fifth mistake that derails potential recession investors is abandoning their strategy prematurely when markets continue showing volatility. Many investors implement a solid buying plan only to abandon it when prices keep falling or when recovery takes longer than expected. This impatience often results in selling at a loss rather than holding through the full recovery cycle. Psychologists call this the ostrich effect, the tendency to avoid information about investments when markets are declining. Instead of evaluating opportunities, investors simply stop looking at their portfolios altogether, missing the chance to accumulate quality assets at discount prices. What separated our case study investors from others who understood these concepts but failed to capitalize? Discipline and documentation. They wrote down their strategies before market turbulence hit, creating accountability when emotions ran high. They maintained journals tracking not just their investments but their psychological state, helping them recognize when fear was influencing their decisions. Most importantly, they followed their predetermined buying rules, even when every headline suggested doing the opposite. What recession millionaires are buying now while others panic? While these recession millionaires followed their investment rules when headlines screamed doom, they weren't just blindly sticking to old strategies. Their current moves reflect calculated decisions based on recognizing patterns they've seen before. What's fascinating about today's market is how these battle-tested investors are quietly increasing positions in traditionally defensive sectors while most financial media focuses elsewhere. They're significantly boosting their holdings in utilities and consumer staples. companies that provide essential services like electricity, water, and everyday household products. Why? These sectors historically perform well during economic uncertainty when consumers prioritize necessities over luxuries. But there's another major shift happening in their portfolios, a surprising move toward high-quality fixed income assets. After years of near-zero interest rates, bonds and other fixed income investments are finally offering attractive yields compared to what many see as overvalued equities. These investors recognize that locking in solid returns with reduced risk can be the perfect defensive play when economic storm clouds gather. What specific valuation metrics are guiding their decisions right now? Price-to-earnings ratios stand out as their primary focus. They're targeting companies trading at significant discounts to their historical averages. They're also closely analyzing dividend yields, seeking out stable companies whose payouts have become especially attractive as share prices have dropped. This mirrors exactly how our case study investors identified opportunities in previous downturns. Their cash management strategy also reveals a key pattern. Rather than going all in at once, these investors are maintaining substantial cash positions, typically 20 to 30% of their portfolios. This liquidity serves two critical purposes. It provides a buffer against further market declines while creating dry powder to capitalize on deeper discounts without being forced to sell existing positions at losses. But perhaps even more telling is what they're actively avoiding. Despite some appealing price drops, recession-tested investors are steering clear of companies with heavy debt loads. They recognize that when economic conditions tighten, over-leveraged businesses face significantly higher refinancing costs or even existential threats. They're similarly cautious about highly cyclical sectors that tend to experience the most severe contractions during downturns. This approach directly mirrors their successful strategies from previous downturns. Just as Sarah avoided banks with questionable balance sheets in 2008 while buying financially strong institutions, today's recession millionaires are discriminating between companies with sustainable business models and those merely riding favorable economic conditions. The alternative asset component of their strategy shows another interesting pattern. Many are allocating portions of their portfolios to real estate and commodities as inflation hedges. This diversification beyond traditional stocks and bonds provides an additional layer of protection against economic volatility. Exactly the approach Maria used to protect her wealth during the pandemic market crash. What's particularly fascinating is the growing emphasis on environmental, social, and governance (ESG) factors in their investment decisions. These battle-tested investors aren't just looking at traditional financial metrics anymore. They're increasingly factoring in sustainability considerations, recognizing that companies with strong ESG profiles often demonstrate better risk management and long-term resilience during economic upheavals. The playbook is clear. Focus on quality over quantity, prioritize strong balance sheets, maintain strategic cash reserves, and avoid excessive risk. It's the same disciplined approach that separated our case study investors from the panicking crowd in previous downturns. The wealth transfer. Why economic uncertainty creates more opportunity than stability. That disciplined approach doesn't just help investors survive downturns. It positions them to capture wealth that others leave on the table. Have you ever wondered why more millionaires emerge during economic chaos than during stable periods? The answer lies in a counterintuitive truth about recessions that most financial advisors won't tell you. Economic disruption does not destroy wealth. Rather, it transfers it from the unprepared to the prepared. This perspective completely flips how most people view market crashes. When stocks plummet and property values drop, that money doesn't actually disappear. It simply changes hands. Think about what happens during a market crash. As prices fall, emotional investors panic and sell their assets at dramatically reduced prices. Those assets don't vanish. They're purchased by disciplined investors who recognize the underlying value remains intact. This massive transfer of assets accelerates during downturns, creating a wealth-building opportunity that simply doesn't exist during stable markets. The beauty of economic uncertainty is how it strips away illusions and reveals what's really happening in businesses. During bull markets, even poorly managed companies can appear successful as rising tides lift all boats. But when the economy stumbles, the true fundamentals become crystal clear. Companies with genuine competitive advantages, strong balance sheets, and resilient business models stand out from those merely riding market momentum. This revealing of reality creates incredible buying opportunities. You're not just getting discounts, you're finally seeing which businesses actually deserve your investment dollars. This clarity is virtually impossible to obtain during stable economic periods when everything seems to be performing well. Another fascinating aspect of economic disruption is how it compresses market cycles. During normal economic conditions, the transition from overvaluation to undervaluation might take decades. But during a crash, this process happens at warp speed. What might take 10 to 15 years in a normal market can unfold in 10 to 15 months during a crisis. This compression creates condensed periods of opportunity, allowing investors to capture returns that would normally require decades of patience. It's like getting all your future opportunities delivered in one convenient package. The psychological barriers during economic uncertainty also play a crucial role in wealth transfer. Most people simply can't handle the emotional pressure of buying when everyone else is panicking. Media headlines scream doom, friends and family warn against investing, and every instinct tells you to run for safety. This psychological wall prevents the majority from taking advantage of once-in-a-decade pricing. But for those who can overcome these barriers, like our case study investors, this emotional hurdle becomes their greatest advantage. The psychological difficulty of buying during chaos creates a premium return for those with the mental fortitude to act. If it were easy, everyone would do it, and the extraordinary returns would disappear. Each of our case study investors recognize these wealth transfer dynamics, though they experience them in different economic cycles. Sarah witnessed banks trading at pennies on the dollar during the 2008 crisis, recognizing that while some financial institutions were truly insolvent, others were fundamentally sound but caught in the same selling pressure. Jason spotted the same pattern in tech infrastructure during the dot-com crash, identifying essential services that were unfairly punished alongside truly worthless companies. Maria applied this understanding to travel and hospitality stocks during the pandemic, recognizing that while revenue had temporarily disappeared, the underlying assets remained valuable. What's most important to understand is that economic uncertainty doesn't reduce opportunity, it concentrates it. During stable periods, opportunities are spread thinly across many years and require tremendous patience. During disruption, these same opportunities are compressed into brief windows, offering much higher returns in much shorter time frames for those positioned to act. Your recession opportunity blueprint, implementing these strategies today. While most investors are paralyzed waiting for the perfect moment to enter chaotic markets, the wealthiest 1% are already implementing a recession opportunity blueprint that requires no perfect timing or massive capital. The difference between those who merely survive economic disruption and those who thrive through it comes down to 5 specific preparation steps that almost nobody talks about. Let's break down exactly how to implement your own recession opportunity blueprint, starting today. The beauty of this approach is that you don't need to predict market bottoms or have a massive investment account to get started. First, establish your opportunity fund, a dedicated pool of capital that sits ready for market downturns. Unlike your emergency fund or regular investments, this money is psychologically earmarked specifically for buying when others are fearful. The research shows this mental separation is crucial for maintaining conviction when markets are bleeding red. Start by allocating just 10 to 15% of your investment capital to this fund, keeping it in a high-yield savings account or short-term treasury bills for immediate access when opportunities arise. Next, build your strategic watch list of quality assets with specific price targets. This isn't just randomly picking companies you like. It's a methodical approach to identifying businesses with strong fundamentals that become irresistible at certain price points. For each potential investment, establish 3 entry points: attractive, compelling, and irresistible. Document the specific metrics that would trigger a purchase at each level, whether that's a price-to-earnings ratio, dividend yield, or technical indicator that historically signals value. Implementing psychological techniques to maintain emotional discipline is perhaps the most overlooked aspect of successful downturn investing. The CNN Fear and Greed Index serves as an excellent external barometer of market sentiment, helping you recognize when emotions are driving prices rather than fundamentals. Combine this with mindfulness practices that create space between market movements and your reactions. Setting clear investment goals that anchor your decisions to long-term objectives rather than short-term price swings creates a psychological buffer against panic selling or opportunity missing. When tracking market warning signals, look beyond mainstream financial news, which is designed to amplify emotions rather than provide context. The VIX index, often called the fear gauge, offers objective measurement of market volatility, while sentiment indicators from organizations like the American Association of Individual Investors provide insight into crowd psychology. Economic indicators like inflation rates and unemployment figures add crucial context to understand market movements rather than just reacting to them. Starting with minimal capital is entirely possible with today's investment platforms. The key is consistency rather than amount. Through dollar-cost averaging, investing a fixed sum regularly regardless of market conditions, you can systematically build positions during volatile periods. This approach is particularly powerful in downturns as each fixed contribution purchases more shares when prices are lower, automatically implementing the buy low half of the famous investment advice. The most powerful aspect of this blueprint is that it works regardless of your starting point. By focusing on diversification across asset classes, you create natural protection against sector-specific risks while positioning yourself to capture upside in areas that recover first. This doesn't require complex strategies. Even a basic mix of stocks, bonds, real estate investment trusts, and commodities provides significant diversification benefits. Remember that the most successful investors from our case studies didn't try to time the exact market bottom. They recognized the general opportunity zone and systematically accumulated assets throughout the downturn. Their success came not from having perfect market timing, but from having perfect psychological preparation that allowed them to act when others couldn't. What if I told you the greatest wealth transfers in history don't happen during smooth bull markets, but in times of economic fear and uncertainty? The research confirms this pattern. Between 2009 and 2011, the wealthiest 7% of Americans captured all aggregate gains in household wealth, increasing their share from 56% to 63%. This wasn't accidental. It was a direct result of recognizing opportunity when others only saw danger. This wealth transfer happens because economic volatility doesn't destroy wealth, it redistributes it. Those who maintain emotional discipline during market turbulence position themselves on the receiving end of this transfer. As Marcy McGregor from Merrill Lynch wisely noted, volatility can open up potential growth opportunities as some investments become more reasonably priced. The case studies we've explored aren't about financial geniuses with insider knowledge. They're about ordinary people who recognized patterns others missed. The real question isn't whether